Frankly, are we looking at these numbers, or are we just expecting the stimulus to come, and that's what the market is keying off of anyway?
Well, I think the most important data point in terms of more stimulus that we got today was the jobless claim numbers. So clearly, we are still in an environment where there are a lot of people that are unemployed and need help. There's a huge disconnect, I think, between the real economy and what's happening in the stock market. But I do think that we are going to be in an environment where we're going to need to have more stimulus to support people who are still not employed. So lots of sectors of the economy really are not going to be able to get back to full employment until we can reopen the economy. And so that is going to take some time, and it's going to require support until that can happen.
If stimulus either doesn't come as fast as we expected or comes in a lower number version, what is the impact on the market at this point, you think?
Well, I think there's two sides to the story here, right? Those that are concerned we're going to overstimulate and overheat the economy, and those that are concerned we're going to understimulate. So I think it's going to be a tough job for the Fed, really, from a communication standpoint and from a policy standpoint. And how do you properly stimulate the economy without even overheating Wall Street, which we've been seeing some signs of really excessive risk-taking within the stock market. But as we know, the stock market is so different from reality in the way it's composed and the sector composition there, that they're really two different worlds. So I think we could see some volatility as a result. I would not be surprised. I think it would be healthy development for the stock market to see a little bit of volatility here. But it's not going to be an easy road, I think, for the next 6 to 9 months.
Hey, Rick, what's the view from Chicago this morning?
You know, I think the view is focusing mostly on the fact that the stimulus is a big number. And that big number is going to have to ultimately be dealt with in the debt markets over time. And when you look at it from a global perspective, the numbers are so staggering that, you know, it might not be the popular water cooler conversation to discuss if we really need at this point. Since we've waited so long, we haven't even delegated all the previous funds from, for example, the $900 billion package that was passed. So I think that you're going to continue to see pressure on interest rates, and I'm not sure we're going to actually see the complete package close to $2 trillion get passed. And actually, I hope it doesn't. And I'm not saying that I don't think people need help, but there's a lot of pork-infested numbers in there. Listen, we could talk about things like college debt and the trillions there, but, you know, these are issues that we really need to think about at a time where debt is exploding. And the fact of the matter is we're going to see productivity globally just under huge pressure, probably for the next 5 or 6 years. We're still feeling the effects from the credit crisis. So I think that if you're looking for interest rates, look for them to go higher. If you're looking for corporate spreads, they'll probably continue to narrow to kind of take away some of that pressure that's building in the sovereign markets.
Shepard Smith here. Thanks for watching CNBC on YouTube.